Loan officer training with the mortgage calculator. Today we're going to be talking about how to vet borrowers. Great topic here for today. Remember, we do this at 7 p.m. Eastern on Tuesdays and Wednesdays where we go through a different training topic for loan officers. Today we're talking about how to vet borrowers. We'll wait just a minute here to get started. Let us go live on all the different platforms. We do stream this on YouTube, Instagram, LinkedIn, and Facebook. So let us get up and running on all the different platforms. And in the meantime, go ahead and drop a comment there in the chat as you tune in. We definitely appreciate it. You can also drop any questions that you have as we go through the presentation here today. You can drop those in the chat. So with that being said, it looks like we're live on all the different platforms, so we can go ahead and get it started. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, and I'm joined here by our sales manager, Jose Gonzalez. We are a correspondent lender specializing in non-QM loans, and every Tuesday and Wednesday evening at 7 p.m. Eastern time, we do a loan officer training. Now, today we're going to be talking about something very important, something we've been focusing with our team about, especially lately. So it's pretty fitting that we go over this here today. So with that being said, Jose, our sales manager, 28 years of experience as a loan officer and a realtor. I'll go ahead and turn it over to Jose so he can take us through the presentation on how to vet borrowers.
Good evening, everybody. Hello to our team members out there. Thank you for joining us. These are amazing trainings, a lot of information going on here. Today, especially important for a number of reasons. I guess the main reason I would cite would be overall sustainability of your career as a mortgage loan originator. Right? I mean, this is what it all boils down to. This is where you connect all the dots, right? All your training on products, your training on services, everything that you've learned on how to be an MLO comes to terms when you are trying to vet the borrower. So today's training is how to vet borrowers. So what do we mean by vetting the borrower is, well, confirming the details, right? Confirming that the borrower will qualify and that you will be able to meet their objectives and their expectations. So obviously those expectations have to be based on what is actually possible for the borrower, and that obviously leads us to the licensee, that's us, whose job it is to consult the borrower, guide him through the maze that is financing their property, especially if they're going with an alt doc option, right? Non QM. Uh, we at the Mortgage Calculator pride ourselves in providing solutions, especially outside the box solutions. We are not a cookie cutter organization, right? That is why for us vetting the borrower is so important, because we have so many program options. I mean, if you don't do this properly, you could be leaving money on the table, thinking that the borrower doesn't qualify because you tried to force him into a box instead of thinking outside the box, which is what we love to do at the Mortgage Calculator. We love dealing with our borrowers and seeing their eyes light up with excitement as we give them all the different program options available through us, when they just came maybe from the big box store who told them, I'm sorry, you don't fit in our boxes and we can't help you, right? And we get that all day long at the Mortgage Calculator. So it's very important to vet the borrower. Again, we're talking sustainability, and sustainability means a lot of things, right? Sustainability is created through credibility. Sustainability is created through controlling your costs, 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 and your expenses. It means having a solid marketing plan, and a lot of those things deal eventually with properly vetting your borrower, or else you're just wasting your resources and your time and your effort. And most importantly, we all have to remember the fiduciary responsibility that we have to our borrowers, with us being licensees. We're expected to know what we're doing and to give a proper consultation to that borrower so they don't lose out on opportunities, or worse yet, get involved into a deal that isn't going to be possible to close. And then you may end up with a borrower who's irate because they're possibly going to lose their deposit on the purchase because you told them they could do something they couldn't do. So let's get right into it. Really important to note here, because remember, we're talking about vetting the borrower. That's usually going to happen when you're making the call, right? That initial call, you got the lead, or we've already gone beyond the technology and all that. You got the lead, and now you made the call, and the borrower, guess what? They answered, right? Amazing. So what are you gonna do? Are you just gonna sit there and like, oh no, what do I say now? Well, that's never going to happen to you because of the mortgage calculator. We provide you with all these great scripts there and with included with our technology. But the knowledge that you need as an MLO goes way beyond any scripts, which is just a guide. You only get one chance to make a great first impression when you are dealing with the customer, right? So again, remember, we're talking credibility, right? You want to try to build some rapport. You want to break the ice. So it's really important as a consultant, take the lead, right? Have some direction in what you're doing, and also it helps that as you're doing this, visualize the end result, right? Where the customer will request, what are my next steps, right? Visualize. They're already telling you, what I need to go to, submit the application. Obviously, there's a lot that's going to happen in between that, which is what we're going to cover now. Of the utmost importance, again, always, always, always remember, we are the licensed professionals and need to instill confidence in our expertise as loan consultants. Do not ever, ever, ever assume that the borrower is only interested in the ad program that they responded to, right? Because they could have responded to a DSCR ad, but they could be full doc, right? Which is going to be a whole different ball game. So again, our job is to gather information and assess it, right? So that's what real important. We don't assume anything as we get into the call, right? So that intro call to build the rapport. What is the objective here? Now, this is very, very important. The first point is probably the most important point here, especially when you're trying to control your expenses and not go on a wild goose chase, right? Working on a deal that is going to end up in a dead end. So, the objective of the call is to gather as much information as possible to be able to determine if there is a viable loan option for the customer, right? That's the objective, remember, because if there is a viable loan option for the customer, then you're going to send the customer quote options based on the information that you obtained. And then the next step that progresses after you send the customer the quotes is they're going to find one of the quote that makes sense for them, whether we're talking rates or whether we're talking terms on alt doc. We're going to get into that, but real important that once you send the viable quotes, the valid quotes for the viable loan options that you've identified, then the customer will start their loan application and submit their loan application based only on the valid quote they received from the loan officer, right? That way everybody's on the same page as to what's going to happen. Now, obviously, I'm going to show you the path on how to get to the viable loan, get to the valid quote, so that the customer starts a real loan application for a loan that's going to close. This is not, you don't do this in reverse. You don't send a quote or have a customer start a loan application and then try to figure out if you have a loan. You try to figure out if you have a loan first, right, as much as you can from the information that they're going to provide, so that then you can send valid quotes, and then you're going to reach back out to them. You're going to discuss the quotes, confirm the details, and then they're going to tell you, yeah, Jose, I like the quote that you sent me for the DSCR loan at 7.625%. That's available. That's the one I'm going to do. Boom. They start the loan application. Loan application gets submitted. Credit report gets pulled, and away you go. Either it's a TBD pre-approval, or maybe they already have a property address for the purchase. Now you got a triggered loan application, or it's a refi in which you also have a triggered loan application, right? And then the next step is to close. But that is only going to happen if you have a properly vetted borrower submitting a valid loan application for a viable loan option that's actually going to close. If not, what you end up with at the end is an expired credit report and a credit report expense that basically didn't lead to any loan closing. That should never really happen unless you have an unforeseen circumstance, right? If you properly vet the borrower, you're not going to have unforeseen, you're not going to have non-unforeseen circumstances like everybody thought the credit was 720, but it really wasn't vetted well. Loan application gets submitted, a hard pull gets processed, and the credit comes back at a 490. Now, there's a lot of ways to have determined before a hard pull gets done that the credit report was a 490. You should never have that happen, right? I mean, it should never ever happen. We have so much technology out there available to pre-screen that credit, and we'll touch base on that now as I get into the next slide. But the most important thing is to remember what the objective is here. The objective of the call is not to get the customer to let you quote them and have them submit a loan application without you vetting the borrower and the preliminary information that you're going to gather as a licensed mortgage loan originator that's supposed to know this stuff, right? We're not application takers. We are loan consultants. And the consulting means analyzing the information and consult, not just tell them to submit an application and spray and pray, right? See how much, cover your eyes and throw darts in the dark at the dartboard and see if you get lucky, right? That's not really how we want to do it, because that will not lead to a sustainable career. You're going to spend more time canceling non-viable loan files and paying for credit reports from dead-end loans than actually closing loans, and you're going to get frustrated. And that's easily avoided by just following a few basic steps here, and knowing what your job as a consultant, as a loan consultant, entails. Some of the people you'll be able to help right away. Other people, you have to consult them to help them in their journey to get them ready. Maybe 3 months from now, 6 months from now, 9 months from now, you'll set up an action plan. You'll keep tabs on those leads, on those customers, and eventually they're going to see you as the consultant. And when they're ready and you'll help them along the way, they'll be ready. But even better, along the way, those customers will refer you deals. Believe it or not, we call that the lead flywheel. But I guarantee you, half of those customers will refer you somebody, and you're going to get a deal or 2 or 3 or 4 or 5 out of the people who you're helping get ready, because they're going to so appreciate all the work you're doing as a consultant, helping them get ready, that they want you to make money somehow. Believe me, most people do not want you working for nothing. So they will go out of their way, if you do a good job and are a good consultant, loan consultant, to send you deals. So how do we get to this point where we can vet the deal? Well, let me give you some pointers, real important points, because The last thing that I like to do when I'm vetting any borrower is pull the credit. That is the last thing that I want to happen. I want to make sure that everything's good. I don't rush to pull a credit report. Why rush to pull a credit report to find out it's a 500 and the customer had a hard pull and now you got a credit expense? What's the purpose of that? That helps nobody at all. So obviously, credit is our first important point to consider during the call, and it's pointing. I mean, real nice big bold letters here. Determine if their credit merits an application. Notice how I have that worded. Determine if their credit merits an application. So, how do you do that, right? Well, ask them, do you know your three credit scores? Do you have credit monitoring? Can you provide credit score info like from Credit Karma or a screenshot from the Experian app? Empower them, explain to them the importance of trying to get a little bit of upfront information like that before we do a hard pull and even before you do a soft pull, right? Most people have Credit Karma. It's free. Credit Karma monitors Equifax and TransUnion and the Experian, right? So let them know about FICO 2 and FICO 8, how there may be a difference. The Experian app actually has a FICO 2 feature if they look deep down into it, because we residential mortgage credit reports use FICO 2. So it's like a 20, 30-point difference, higher or lower, usually higher for the FICO 8. But at least it gets us close, right? And we're not going to have that 100, 200, 250 point I've actually seen difference in what they thought they had to what they have, because they may be telling you one bureau, the high one, but what about the middle one? We had one that they said, oh yeah, their credit's 700. Tri-merge got pulled. Experian was 700, but the other bureaus were 618 and 610 because Experian wasn't reporting the derogatory credit. The others were. That's why we asked for 3 bureaus or at least 2. If it's 2, use the lower of the 2. If it's 3, you use the one that's numerically in the middle. So real easy peasy. I've had them at 10 o'clock at night send me the screenshot of their Credit Karma as I'm talking to them via text. That's not talking, communicating via text with them, and they send it to me. And then we finish, and then I send them the valid quotes, and then they did the loan application right then and there, right? So that is, if you're going to remember anything from this training tonight, it's those first 2 bullet points. Do they know their 3 credit scores? Do they have credit monitoring? Can they provide credit score info like a printout from Credit Karma, screenshots, or anything like that? Give you some. Most people do have that, and most people will be more than happy to oblige if you tell them this is so that we don't have to needlessly pull your credit. If it turns out your score is way too low, it's better to just start, maybe do a soft pull and get you going in the right direction, and then set you up. They're not going to mind you telling them the truth and helping them out, get them where they need to be, instead of filling up their head with hot air and getting nowhere and having a credit pull for nothing and a loan application submitted for nothing, and then it's a triggered file, and then we have to cancel, and we got mortgage call reports. Oh my God, talking about a lot of money being spent, a lot of resources. Remember, this is not sustainable for no reason at all. This should never, ever, 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 ever happen. So I want to tell you again, this should never happen. Okay, so let's move on. And then you want to ask them, any credit events? Have they applied elsewhere? If they did apply elsewhere, what happened? Was it denied? That's okay. Remember, we want to be able to provide solutions. Maybe it was denied, it was full doc. Maybe they don't qualify full doc. That's all right. We'll still review tax returns, but keep in mind all the options that we have at the mortgage calculator. And again, it's extremely important to vet the borrower's credit scores as much as possible before an application is submitted and a hard pull is processed. Remember who came first, right? So you don't pull the credit and then find out if they qualify. You want to vet them a little bit as much as you can, and then have that loan application submitted and the credit pull. The next point that you would want to cover now that you've determined that credit's not an issue, and I like to have my outline, which you should, and then I like to be writing notes. I'm definitely writing notes because I got my calculator right there. Because when we get the income, I'm gonna do some initial analysis because I'm gonna ask them, okay, what price range are you looking at? Okay, you're looking at $300,000. Okay, and you what do you think you're gonna be looking to put down? 5%, 10%. Okay, so you're going to be financing 90% of 300, so 270. All right, for right now, let's just assume 6.5, 7%. So I'll do a calculation right then and there. Okay, for this property, you're going to have roughly 12, whatever, $1,500 principal and interest. Let's assume $250 a month for taxes. This depends on the market, obviously, and $250 a month for insurance. And if we're going to go with a conventional and agency loan, there's going to be some mortgage insurance at less than 80%, at more than 80% loan to value. So let's put a little bit of that in there. So for purposes of our conversation here, you probably would be looking at a payment of like about, let's say $2,300 a month, Mr. and Mrs. Borrower. Okay, I'm going to keep that number here, and let's talk a little bit about your income. How do you report income? Right? Are you self-employed? Okay, you tell me you're self-employed. Okay, do you have tax returns for the last 2 years? Yeah. Okay. What did you report net income the last 2 years? And then if they tell you obviously there's no tax returns, then plus you still want to talk about them saying, well, because if there's issues, we're going to review your income based on the tax return. But since you're self-employed, we do have some great options. Bank statement for income is a great option where we can use 12 or 24 months bank statements, and a profit and loss is another option also for self-employed borrowers. So those are options we'll get into once we can review tax returns. But you're telling me your net income is about $120,000 a year, so you're at about $10,000 a month, right? What type of debt do you have? Do you have a car payment? Okay. Do you have you co-signed for anybody in anything? Do you have any student loans? Are they deferred? Are you making payments? What is your minimum payment on all your credit cards? People know these things. They have an idea, unless they're super complicated. Unless they say, "Oh, my wife does it." I don't know. Well, hey, where's your wife? Call her over a minute. And I'm writing down these notes because remember, I haven't pulled a credit report yet, but they're loving it. I'm asking them for information. They're going to know if it's like, I hate to use this word, but it's like a pre-qualification that we're doing here per se, but we don't pre-qualify anybody as a pre-approval. Remember, this is just to get the ball rolling. And then so we have a housing payment, we have their income, we know what their minimum debts are, and then I'm going to be able to tell them, more or less, based on the information, your housing expense ratio is about 30%. That's pretty good. That should get us where we need to be. And based on the debts that you told me you have, your total debt ratio is about 44%. So we're in pretty good shape. I think that we'd be fine with an agency loan or a non-QM loan full doc with these numbers as long as nothing changes. Same if they're salaried. Any bonuses? How long have you been salaried? How long have you received these bonuses? 1 year, 2 years? Because remember, bonuses, like any other variable income, is averaged over 2 years. If they're hourly, do they have a year-to-date pay stub handy? What's their year-to-date pay? What's the pay through date on that pay stub? Oh, really? That means that you're at about $4,400 a month. Okay, based on $4,400 a month, your DTI is, and you get the picture. And on the variable income, which is commissions, tips, overtimes, bonuses, you're going to find out how long they've received the variable income. The key component here is 2 years, you're guaranteed to get it, at least 1 year plus. There's a good possibility you get it with a strong verification of employment from the employer, right? If it's not on the actual VOE form, we got to get a letter from HR or management as to what's the probability that it's going to continue in the coming year, because the year-to-date pay stub hopefully shows it as well. So you get the picture. We try to calculate some initial DTI numbers there, and all this sounds complicated, but it's not. After you do it a couple of times, this is second nature. You're talking to them, you're writing notes, and they're taking it down, and they are absorbing this information, and they're loving that you are caring and knowledgeable, right? To consult them in this manner, right? Because most people, are just used to being manhandled, and maybe a processor takes over. They never hear from their loan officer again. That doesn't result in sustainability either. You're not going to get referrals. Referrals are easy business. This upfront work initially with a borrower results in many years of referrals after you close the deal from the borrower, believe me, and the lead flywheel even before you close it. So now we've covered credit and we've covered income. So now we know that credit will be okay. We figure the income will be okay. Remember, now we're making program determinations here also based on if we got to go bank statement, P&L, do we got to go DSCR, because there's no way I don't have tax returns. My bank statements are nil, and I don't want to deal with it. I have 40 properties, and it's super complicated. I don't even want to get into that. We got, I want to do DSCR. Okay, then we do. If that's what they absolutely want, and nothing else fits their objective, then DSCR it is. But that's the cool thing of having all these program options, and the cool things about vetting the borrower with these questions, make them think about it, confront the situation in a nice way, so that they, everybody's expectations are on the same page. So we covered credit, we covered income. What other important points do we have to consider? Well, assets. And I, this is like in order of importance, pretty much. Assets. Determine if they have the needed cash to close. What is more important than that? Okay, the credit is like being ready, willing, and able, right? This is the part of the ready, willing, and able test. Okay, credit is good, income is good. Show me the money, right? So now you have to determine if they have the needed cash to close. Confirm it. I mean, at least verbally confirm it by asking them, and the reserve requirements for the selected program based on your initial analysis. If you're thinking this is going to go agency, agency determines reserve requirements by DU, but if you're going to do a 95% or 90%, and then if they're going to have you do a reserve requirement or not, that's going to depend on AUS. Non-QM is determined by the guidelines for the loan type, primary, second home, investment. Look at the grid that lets you know the reserve requirement, and you have an idea after doing a few of these loans what type of money they're going to have to bring to the table. Excuse me. And identify any potential asset seasoning issues, like, well, I'm going to get the money as a gift. Okay, well, then let's make sure that gift is done properly. Or I'm going to get it here, I'm selling this, I'm selling whatever it may be. Make sure that it's structured properly to not present any seasoning issues on the large deposits wherever you may be submitting the loan, right? You can identify these potential issues up front. It won't be an issue when underwriting is going through the file and telling you, you got an $80,000 deposit that came from nowhere, and the customer says, well, Jose, that was cash. Oh, really? You didn't tell me it was cash. Oh, no. So deal may be dead there unless it's submitted to the right conduit. And then the last determination, but definitely not the least, is property, the actual property. Determine if there is any seasoning on title issues for the borrower, if we're talking about a refi, or the seller, if we're talking about a purchase. And yes, I don't want to blow your mind, but if the seller has been on title less than 12 months, that's considered a flip, and additional restrictions may be applicable, and they probably will be depending on who the conduit is. If it's 30, if it's less than 90 days in a certain percentage, or 91 to 180 days on title and a certain percentage of capital appreciation, equity increase on the asset that's being sold, then they'll probably require a second appraisal. And in some investors, they won't care if it's less than 12 months. They're going to give you the seller's purchase price plus the seller's renovations, and that's it. So that's not, that varies from conduit to conduit. So you really got to review the guideline and know that if the seller's been on title less than 12 months, review it and see if it's applicable to your deal, right? FHA, for example, you can't get into a contract until the seller has been on title for at least 91 days. And then after that, there's going to be some requirements possibly for a second appraisal if there's too much equity appreciation. And on a refi, that's the one where it's a little bit more common seasoning on title, because if you want to get the market value instead of purchase price plus renovations, there's certain seasoning requirements. We have options for zero on DSCR, some DSCR with 0 month seasoning to get the market value for the appraisal. We have some that are 3 months on title. We have some that are 6 months, and then 12 months. And in agency, it's you got to look deep, because I think in agency it's 12 months on the cash outs, right? To get market value versus purchase price plus renovations. I think they just recently changed that. So keep an eye on all of that seasoning. You don't want to get, and again, I'm not talking salt and pepper here now. I'm talking about seasoning on title. How long have they been an owner of the property? Now, if they currently own it in an LLC and they previously owned it in a personal name, and then they can show the paper trail that they're 100% owner, or the people that were 100% owner of the property in a personal name are the only owners of the LLC, that's just a continuation of the ownership. They just changed the name of how they were vesting, but it's still them, those same two owners. There is no seasoning issues. However, if the guy bought in a personal name, switched it to an LLC, added a partner to the LLC, now that's a vesting change, and that's a title ownership change, and day zero starts when the new name went on there. So keep an eye out on that. So again, all this is going to lead us down to program options determination, right? Are we going AUS, like agency loan, or are we going manual underwriting? What are the customer's expectations versus what may or may not be possible? Empower the borrower with information and knowledge. This is my favorite. You empower them, man, it's going to be so much easier when they got to make a decision on the loan application. Always be the consultant. That's an intertwining thread on the mortgage calculator, corporate philosophy. Always be the loan consultant. So if we go with the conventional pre-approval or agency, depending on if it's FHA, USDA, VA, remember, we're looking at automated underwriting, either DU, which is approve eligible, or LP, which is accept, is a must to issue the pre-approval letter. Remember that MI is always required above 80% unless it's a combo loan for conventional. The conventional loan and the agency loans in general always going to be full doc. Trade line requirements and credit is per AUS, as is pretty much everything else through AUS. And assets, if required, will need to be sourced and seasoned. And if it's non-QM, the route that the path of your loan takes, always manually underwritten. AUS, in other words, DU and LP, is never applicable for a non-QM loan. Every now and then I get the MLO stuck. Hey, can't get my DU approval on a DSCR loan. Okay. You, as the MLO, need to review all income, asset, credit docs, and reconcile to the loan guidelines, because you are the AUS when it's a non-QM loan. You're the DU. You can only issue the pre-approval letter after a thorough review is completed and you confirm that the borrower actually qualifies. DSCR pre-approvals allow borrowers to compete well against cash buyers. Remember that. We love that strategy. And again, here we are at our desired objective at the end, right? We went from vetting the borrower to issuing the pre-approval to getting our loan application to now getting our approved loan. So again, I take you back to the beginning, though. If there's anything you all remember from this presentation, remember how important it is, starting with vetting the credit and making sure it is actually what it is, right? No surprises, so that you can give a proper consultation and so the borrower can submit a valid application for a viable loan product. And in the end result, everybody's happy because you got a closed loan.
All right. Great presentation there, Jose.
Thank you, sir.
I don't see any questions. Is there an AI tool to calculate income?
I mean,
Well,
we have an AI tool in the CRM which does most of the legwork for the self-employed borrowers when you upload tax returns, right? That's it. But there's still some determinations in the test that you need to click on to finalize the income. Like if you're using 1 year or 2 years income, for example. And again, remember that when you are self-employed borrower and averaging income, you can't average a higher, let's say a higher 2022 with a lower 2023 income. So then you would choose the lower and choose 2023, and then you'd have your income calculated by the worksheet. Those are the types of determinations that the AI won't always make for you. So it's not 100% on the AI, but we do have the tool for our team when the tax returns get uploaded, AI will review it.
exactly. That's what I was just about to say. When you upload the tax returns, it will pull the numbers out of there and do the calculations for you. But just like anything with AI, that's not going to do everything for you. Like Jose said, you're still going to have to double check things, look into it, make those determinations that only the loan officer could. But it's definitely a cool tool. That's for sure. I don't see any other questions here, but that was awesome there, Jose. And as you said earlier, too, we have the call scripts there for whatever type of lead you're calling when you're calling people here at the Mortgage Calculator. But it goes much further than just what can fit on a screen for a basic call script to get the basic information to send a quote, right? We want to try to do this as much as possible, what we just went over, which can't just all fit into a script on your screen. So,
Absolutely. I mean, I think everybody should grab this presentation. I mean, all our team can go to our database and they can see these presentations. This is one that you should keep handy and review it, or go to the recording of it and view it occasionally for our newer MLOs, because this is really the one that's going to let you see the light and not spin your wheels.
all right, sounds good. Well, we appreciate everybody tuning in. Remember, we do this Tuesdays and Wednesdays, 7 p.m. Eastern. So tomorrow we'll have a new loan officer training subject. We appreciate everybody tuning in. Thank you, Jose. Great presentation. And we'll see everybody tomorrow, 7 p.m. Eastern, for the next episode of the loan officer training with the Mortgage Calculator. Have a great night, everyone.